First, there was the high return real estate show, now upgraded to the higher return real estate show. Deeper insights, greater value. It's time to build your empire.
We have been through the ringer with our business and we're really excited about what we've got going. So we want to talk to you guys today about short-term rentals, Airbnbs, VRBOs, looking at tenants that are going to come in for a day, 2, 3 days, and how much more profitable this can be in terms of cash flow.
So by definition, this is the way we tend to look at it, is STR, meaning short-term rental. I would consider that anything that's a few days, probably, anywhere in that less than 30, right? That's what you were saying, like the Airbnb, the VRBOs, the people that just want to come in for a weekend, that sort of thing. It's almost like playing hotelier or hotelier.
All right.
The MTR is medium-term rental, and it's a market that we're finding to be extremely profitable. MTR is anything that I would call 30 days plus, but not enough to where somebody really wanted to sign like a 1-year lease in an unfurnished place, right? It's not necessarily their permanent home.
Sure.
But it is a temporary home for a while. Those might be like doctors that are on call for a few month long research project, traveling nurses, a lot of the corporate relocation, like for example, I had a guy knock on my door the other day who just was going door to door trying to sell me an internet-based security system for my new home. He would happen to mention to me that his whole crew, none of them actually I'm in Nashville, none of them live in Nashville. They just got put up at an apartment, a furnished apartment, his whole crew. There was like 30 or 40 of them.
And this was for how long? Was there?
Yeah, their gig is 6 months. He said it absolutely would not go more than 7.
And because they're staying, it's fully furnished, right? And they're staying for a shorter period of time, you can charge them more rent, right? So you're making more than you would if you would have gotten a long-term tenant. And I want to hear about your experience with your Indianapolis residence that you converted when you moved to Nashville. Instead of selling it, you converted it to a short-term rental. And obviously it's been working out extremely well. And then let's also compare it to had you just long-term tenanted it, right? What do we call those? LTRs, a long-term renter?
Yeah, exactly.
So we got STR, MTR, LTR. So the only thing that changes is it's either short, medium, or long term between the three. So let it rip, man. What happened? You got this, you fixed up this house.
I bought a crappy old boarded up house in Indianapolis back in 2017.
It was a disaster.
Disgusting would have been a nice term.
Right.
So this property had not been lived in for 15 years, something like that. Boarded up, dead squirrel halfway up the stairs that was kind of petrified at this point. But it was in an area that I thought was coming on. And so if you look to the left, you could see and hear gunshots. You look to the right, you can kind of see all the cool stuff going on and some new builds and some, big rehab. So it was right on the line. But it was in a good area that I guess in most towns you'd call that like uptown. Just a little bit north of downtown, but it backed up to a creek. So it had a really beautiful setting. But this house got gutted. Redone from top to bottom, all new siding, all new systems, new everything, basically. I did save a lot of the old woodwork, which is the attraction to it. The home's 100 and something years old.
Yep.
And the intention was it was going to be my primary residence in Indianapolis. Well, then, as a lot of people know, our business expanded and a lot of good things started happening, which is great. And after COVID, we kind of we definitely did reinvent ourselves in some very good ways and started having a lot more educational stuff and different offerings for investors and just more opportunities. And it made sense for us to move into multiple markets. So myself and another business partner ended up in Nashville, and that was a few months ago, and it's been great. So at the time, I was like, well, what am I going to do with my house? This was last summer. Market in Indy was hot. And I'm thinking like, great, I'm just going to sell this thing, pull all my chips off the table. I had obviously done the work, I thought, fairly reasonably. And, I thought I was going to pull $250,000 in cash off the table. Unbeknownst to me, the city had decided at the time that they were going to finally fix the sewage that kept getting dumped into the creek behind the house that's been going on for 100 years. Now was finally the time to fix it. So they got all these gargantuan culverts. They got everything dug up, and just when I put the house on the market, they closed off all the streets. So couldn't get any showings. On a spiritual note, it's like God, the universe, whatever you want to call it, I really feel had my back.
Yeah.
Because I really wasn't supposed to sell it. It's not that I didn't get any good feedback on the property from the few that saw it, but there were very few that could even get in to see it.
Okay.
So I looked at the LTR numbers, and it's a pretty nice house. I had redone the attic, created a second master up there. So, I probably could have gotten $2,500 a month from a long-term renter.
You wouldn't have had much positive cash flow. I mean, you would have had some, but it would have been pretty tight, right? At that.
Yeah, because there's still, I've still got money owed on the property. I've still got to make a payment every month. And,
right. You got insurance, taxes, maintenance, repairs, all that.
Yeah. And, thankfully my CapEx was pretty low because, understand that all of it had just been redone.
Yep.
So I started looking at that and going like, I don't know. And then I started researching the LTR and MTR numbers.
Sorry to interject. CapEx for the listeners, guys, that's capital expenditures. So on a real estate property, that would be like all your major items for roof or a furnace or a foundation or electrical, plumbing, like all those major items. If those are new, you have a very low chance of those needing to be addressed anytime soon over the next, say, decade, right? So when we talk about CapEx, and he's saying, well, I won't have many CapEx expenses. What he's saying is essentially everything was just updated, really good condition. We know wear and tear is there, but that's not going to be for a long time till we'll probably have to address those items and replace them. Then CapEx is different than maintenance and repairs. Maintenance and repairs is all the little things that break and go wrong in a property that are 100, 200, 300, 400 bucks, right? Those are your smaller type items. So anyways, sorry, just had to make sure everybody was clear.
Yeah, no, it's good to clarify that. So I started looking at the numbers in terms of STR and MTR. It just sort of made sense. The property management team that we were very involved with was already getting into it. And I already knew a guy through real estate stuff in Indianapolis that was doing some STR, MTR stuff. And I gave it to him to manage. And it's just been great. You definitely pay more in management fees, but I had done Airbnb of my old apartment way back in the day when I lived in Austin. So I looked at it and said, okay, I'm going to put in additional money into my home, which I didn't really want to do. But I ended up building a staircase from that second master in the attic. Put in a little like coffee bar up there, and I made it to where that attic could be a separate unit if need be. Separate entrance, separate Wi-Fi lock, all that kind of stuff. And then the door that on the second floor that leads from the second to third floor, I just put a deadbolt on it. So this way I had the choice. I could either rent out the whole house with two masters, whatever, right? Mm-hmm. Or if I wanted to just rent out the main house and then the attic separately, I had that option because I had the separate staircase on the outside. It was not cheap to build a staircase and cut into the roof line and all that other kind of stuff. By the time I got done, it was probably $7,000 or $8,000 just to do that. Mm-hmm. In addition to my rehab costs of completely redoing the attic. So there was some money put into it. We ended up getting kind of almost like a hybrid between an STR and an MTR. So meanwhile, these are people that are coming from overseas and they're staying 30 days at a time and they renew every 30 days because they're doing some work. There's a lot of Indianapolis, as most people know, its nickname is the Crossroads of America. So there's a lot of interstates that go through there, and there's a lot of warehousing and trucking and logistics, things like that. So there's a lot of companies that are coming in and building out all these Amazon and other company type warehouses, and they're building all the conveyor belts for the product that moves through there. This company actually was involved in that build out, and they were sending workers over to do that. So they've been renting out my whole house literally since the day I decided I was going to do that.
What are you getting in rent?
Those rents are around $7K a month.
Wow. So you're talking about long-term tenant. If you would have just rented it out to somebody who lived there, for a year, 2, 3 years, whatever, 2,500 probably on the higher end, and you're getting over 7,000. You're getting
let's be clear. They're more expensive. So
yeah, I got it. I we're going to walk through that, but still, the fact that you've got almost triple the rent.
Yeah, I mean the numbers are off the charts. But
yeah, it's crazy.
There are some distinctions there. Number one, I went out and got a different insurance policy on the home that specifically spoke to STR.
Is that a higher premium?
Yes, it was a little bit. No,
okay.
I found a pretty good deal with the relationship that we had, and I shopped pretty hard. But yes, I got that done. Then, understand on an LTR, a management company is going to charge you 10%.
Sure.
An STR, MTR, you're going to have companies that charge you anywhere between 20, 25, and I've heard of some situations even charging as much as 50%. You got to understand that they're going in and having to organize ins and outs of guests and, all the marketing and getting new people in there all the time and washing sheets and, all the stuff that they've got to do.
It's way more intensive when you have tenants that are coming in and out that quickly. Way more intensive on management. So you can't say, like that they're ripping me off, that I'm paying that much more in management out of the rents. It's a very intensive nature. And if you want to do that yourself, that's a lot of work. You got to have a lot of great systems in place to be able to pull that off on your own.
Because of my experience, I did it right. I was living by myself in this big house. You can judge me, whatever, but I was enjoying it. In the living room, Jack, you know the house pretty well because you've been there a few times, where there's a nice fireplace. I bought a big, beautiful dining table. Gorgeous. I spent a bunch of money on it because it's like a showpiece.
Sure.
Now I got service for 12. I bought 12 matching chairs. I bought all the matching dishes, the nice towels. Like, I made it nice.
So that's an expense that people have to consider when they buy an Airbnb, is the staging. You have to, in terms of staging, you're furnishing the whole house from everything.
And I bought more beds and all kinds of stuff and better towels. And I didn't use my old, crappy bachelor towels.
Right. You're leaving plates and silverware too, right?
Yes.
Yeah. So you're talking everything, right? Except your clothes and wardrobe.
It's a little bit nerve-wracking because you kind of go well, God, I hope they're going to renew again for another month. Because if not, then, where are we going to get the next bit of revenue? Right. So it's not obviously as consistent. I've been very lucky and very blessed in this particular case that the people that come want to keep coming back, and they don't really ever move out. They just hammer their employers overseas. They're in Europe somewhere, and they go, okay, we want another month. But it's all done very last minute. I do notice that there is more wear and tear. Every once in a while, they're like, well, we destroyed this towel, we ruined this pair of sheets, broke 3 dishes, for the sake of keeping peace. You just end up, because these people are paying you a lot of money, you just pay to replace them. They're not even remotely cognizant of energy savings. It's hot, they got the air conditioner running 24/7. If it's cold, they got the heat running 24/7. So
you don't want to trip over pennies to lose dollars.
Right. Yeah. So, and then of course I'm paying higher management fees. So, but all in all, even after all that, and additional insurance and additional utilities, and incidental expenses, I'm still probably netting out about $5K a month net. And
that's net profit?
That's net take after the property manager pays me.
Okay, gotcha.
I still have a note on the home that I'm trying to leave that out of the conversation so that just people can be clear about revenue per se. So let's say, assuming that somebody owned the house outright, the net revenue would be $5K. The net revenue on an LTR, if they were paying their own utilities and you're only at 10%, right, probably would have been, I would say, $2,100 or so per month. So heck yeah, will I take the $5,000 over the $2,100? Absolutely, for sure. Same mortgage payment, but all the other stuff, there's some differences, and I wanted to point out those nuances. As a result of this, obviously in our world of real estate investing, we are becoming heavily invested in the STR, MTR model, not just for our own portfolio, but helping other investors with that as well. There's definitely higher risk and there's definitely more volatility. I'm not saying that every instance is going to be, I feel like I had some blessings, some luck, whatever. There were, a few things that the stars aligned pretty nicely. And I can't honestly say that that's going to happen at every property, right? However, because of previous experience that I had had in other markets and what we are also already doing in other markets, and some of the marketing, the outreach marketing that we're doing, especially in the MTR world, we're starting to see some pretty nice results. That's definitely an avenue that is becoming more and more available to our more sophisticated investors, let's say.
Hey, thanks for supporting our show. If you want to find great rental properties that are not available to the general public, subscribe to our Insiders Club email list. Just head on over to highreturnrealestate.com and wait for the pop-up.
I mean, I guess it's possible. It's not anything that we're going to participate in.
Right. Yeah.
Like
I don't think that's anything that we're going to set up our investors with either.
No, look, everything's got a market. If you went on to Airbnb today and said, hey, I want to find a place that goes for $30 or $40 a night, you can find that stuff. It does exist. So I'm not saying there's not a market. It's just not a market we want to be in. So to answer your question more specifically, there are things that we are looking for specifically. One, obviously, we want to be in nicer neighborhoods. We want anybody that's coming to as our guest, because it is a guest, it's not a permanent tenant. They want to feel at home. They want to feel safe. Other thing is, as the realtors say, location, location, location.
Sure.
So we're looking in areas where what are they near other things that they want to be doing, both professionally and socially. So for example, if you're in Indianapolis, yeah, you want to be close to downtown where all the action is, right? You want to be in some of those cooler, hip neighborhoods surrounding downtown where obviously price points are higher, right? I mean, those are the hip happening areas where all the good restaurants are and the cool coffee shops. And the other thing that we look for is, like, on the professional side, we seem to have guests that are, let's just say, for example, one of the more popular buckets is the medical field. So like your traveling nurses or doctors that are coming for a few months to work on a research project or something like that. So we start looking at, well, is the home that we're looking to purchase, what's the proximity to the major hospitals and the major medical facilities? That becomes an issue. Those are just things to look for. So when we go out and try and find a property for an investor and ourselves, we're doing the same things. I mean, we don't want to put an investor into something that we wouldn't do ourselves, obviously. Like, we're very clear about that. Probably one of the reasons why we don't want to be in the $30 a night thing either. We just don't want to be there. So why would we talk an investor into going there? It just doesn't make any sense. But anyway, that's kind of the way it works out. I guess the other thing I would say for the investor is, what are the things to look for? Because that's kind of the part B of what you were asking, is what's involved. Well, obviously, if you're going to find a property, no matter what kind of property you're buying, we're in pretty much a tight market all the way across the country. So whoever you are listening to this, the best advice I could give you is get your ass pre-approved. Understand lending products. Understand what some of your tax breaks might be going in, right? Because obviously if you're rehabbing a property, if you're buying, dishes, towels, all that other kind of stuff, those are costs associated to getting the property ready to be marketed. The more educated you are in that regard, the easier it is for you to make a decision. So in other words, buying a property these days in a tight market, you're better off knowing this stuff because now you've got more metrics to help you make a decision. It's like, okay, well, I know I can get this kind of lender, this kind of lending product, this kind of structure to the way I buy the property, based on my own income and based on my credit rating and things like that, right? In addition to that, here's what kind of tax breaks I need. Maybe I've done some tax strategy up front and I go, okay, I know that if I buy, because of my income and where I'm at and what I paid taxes in previous years, if I find a property that needs approximately, this is just an example, say $60K worth of repairs, rehabs, set up for MTR, STR, I was paying enough taxes that $60K is just going to be a write-off. So the IRS is paying for most of it, right? So to know that stuff up front is freaking awesome. That kind of investor is going to be able to go, like, we put a property in front of them and they go, yeah, I mean, I can make a decision in 24 hours. Just go find me something. And so we try to help with pre-structuring of that stuff to say, let's get you armed and dangerous, right, as it were.
Yeah.
And go, great, this makes sense. You probably need to be buying approximately a $200,000 property that needs about $60K worth of readiness, right? And, again, readiness is going to tend to equal the kind of property that it is, right? Like, what's the area? What kind of tenant or guest are we going to be attracting, et cetera, et cetera. So needless to say, like the furnishings, the furniture itself, the dishes, the towels, all that are going to be different in a $200 a night place than they are in an $80 a night place.
Sure.
To further answer your question, I'm sorry if I'm rambling, but I'm just trying to get all this stuff out that you basically asked one very big question, is this is just a general rule of thumb. And there's a lot of variance to this, but we figure approximately about $5K readiness costs per bedroom. So
Okay.
in other words, if you got a 3-bedroom house that you're trying to furnish and get ready for STR, MTR, you're looking at probably about $15,000 to get all the furniture. And, obviously you got to pay people to buy it and put it in and stage it and get it all ready. It's not just the cost of the furniture.
Yeah.
There's a lot of setup work and all that stuff too. And there's a lot of labor involved in doing that.
In all likelihood, they're not going to get anything under 100K. Like, you're probably buying properties 150,000 on up in all likelihood.
Yeah.
If you want to be in a good, like you said, good area, good location, house that's, depending on how much rehab it needs, of course, going to vary the price. So let's just say, like, okay, we got a $150,000 house. What's the loan requirements? And I don't think that anybody personally, this is my personal opinion. Everybody has their own risk tolerance, right? But I think that you really ought to be looking at using debt, use lending. Real estate's the only asset class that you can invest into that the banks will loan you money up to typically 80% of the purchase price or the appraised price. Why not take advantage of this incredible offering that banks and lenders are giving to us to utilize leverage to accelerate our returns and be able to get more assets under our control? I don't use cash for any of my properties. I might use cash to initially buy them. They need a lot of work and I'm not able to get lending. But overall, even if I use cash, I'm getting it back out as quickly as I can to put it into the next project with a refinance, right? So we got a $150,000 property. So what are we looking at, Shecky? I mean, what's an investor going to need to come up with cash-wise to make this happen?
Well, it depends on the condition of the property, obviously, but
let's just say the property's already ready. It's turnkey ready and it doesn't need anything.
Well, that's great. Those aren't as easy to find, but let's use that as an example because it keeps things simple. So typical guy, $150K property, if they're putting 20% down, that's $30,000 plus closing costs. Let's just say 35 in round numbers, cash out of pocket. And then let's say it's a 3-bedroom home and we go back to our approximation of $5K per bedroom. So there was another $15,000 in readiness, right? So now you're up to $50K basically in cash that you put into that property to get it ready to be marketed. That's it. Pretty straightforward.
Okay.
Right? To further say, I agree with you, by the way, about leverage. There's no question that we are in an inflationary period. I mean, like, okay, I understand, like, I'm being Captain Obvious, right?
Yeah, I know.
Okay.
Captain Obvious to the rescue here.
Right. But at the same time, you've seen in the last few months, some like costs of food in some cases have been going up 10 or 12% a month, not a year.
Yeah.
Right. Like we're just this crazy stuff going on right now. So if you think about even with interest rates, as of the recording of this, going up 5, 6, 7, 8%, right, as opposed to 2, 3, 4, 5%, which they were a few months ago, it's still a number that's significantly less than the inflation rate. If you're going out and buying that $150,000 property and you had $30K down, basically your notes for $120,000, right? You're borrowing $120,000 at, let's say, 6%. The inflation rate's 10, 11, 12, 13, 15, 20% right now. I mean, the value of homes is going up like crazy. You're still.
Now, will that continue, right? That's anybody's guess.
It's anybody's guess, but you're still way ahead of the curve, number one,
Yeah.
right now. Number two, you're basically getting to borrow money. You're paying a cost of not having to use your own cash. You're using somebody else's money to have a cash flowing asset. How are you doing that with a stock? I mean, you're going to go out, maybe you get a dividend.
Yeah.
Right? But you don't have that control. You don't have a property and go like, let's say worst comes to worst, you suck, or your manager sucks at STR, MTR. You suck. It's not working out. It's too volatile. Like, it's just awful, right? Like, I bought all these dishes, blah, 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 blah. Well, guess what? You still have a long-term note on a nice $150,000 property. You can still LTR it all day long, right? So when you think about your lending, think about that. That's probably the best advice I could give you, because this is what we look at. What would happen if everything failed in terms of STR and MTR? And if you had to go LTR, right, would you still be able to service the note? Because LTR is going to obviously be the most stable. It's going to be the least profitable, but the most stable.
Yeah.
And, we live in very unstable times. So again, this also speaks to different investors have different risk tolerances too. And that's, this is just time where you have to do self-assessment, right? So it's just something to think about.
I think that too, if you have more than one short-term rental, you're really going to mitigate your risks quite a bit, by economies of scale. Okay, so you got 5 properties under your belt that are all short-term rentals. You could have one that has a bad stretch. It doesn't rent up for a month. I don't think that's probably even possible, but let's just say it doesn't work. You don't have anybody. Well, you got 4 others that are generating really nice cash on cash returns that are going to be able to more than cover that one when it goes through its down period. Whereas if you just have one property, then you're a little bit more susceptible to the volatility. You don't have enough, assets to kind of smooth out that volatility. The more properties that you stack up in your portfolio, the more that you're going to smooth out the overall monthly cash flow, and you're going to start to see some consistency. Leverage, right? Like let's say in this example, this property for $150K, you've got $50,000 into it and it goes up to $200,000. Well, that's your gain. That's not the bank's gain. Their bank's note stays at $150. You just doubled your money. On top of that, you have all the yield, or the yield meaning the cash flow coming in from the rents. So now, you've got multiple streams of income on this property. In addition to the tenants that are paying you the rent, you're amortizing in a sense, which means you're paying down the principal balance of your loan. So now you're building equity or net worth that way as well. So there's so many ways to generate increases of net worth when you do this type of plan, especially when you utilize leverage. That's why you guys, I keep pounding the table that you got to have real estate exposure in your portfolio. Get it. It's not that easy to come up with 50,000 as a new investor. I think the hardest part of investing, in my opinion, is going from, 0 or in debt to having 100,000 to work with. Once you get to 100K, my opinion, I've said this before, I think going from 100K to 1 million is easier than going from 0 to 100K. Momentum is a big part of it. And I think the universe says, wow, you're a good steward with the smaller amounts. I'm going to bless you and increase you and give you more because you've proven that you have the ability to handle the smaller amounts. So in terms of Shecky, what else should the investor kind of be looking for, or experience wise? They got to come up with the cash for, the down payment, 20% down. They got to stage it, right? They're going to have management fee, 20, 25%, 30%, maybe, whatever, somewhere in that range. And then what?
Rock and roll, baby.
Right? Rock and roll. Let's go. Let's make some money.
As we live in a very technology-driven world. I'm not necessarily good at tech, but you know me well enough to know I really appreciate tech and appreciate what it can do.
Yep.
And what's really interesting to me is the amount of tech that's coming into the space of STR and MTR. And I don't just mean like platforms like Airbnb or Furnished Finder or anything like that. Like those are more like the marketing platforms for people to see, for guests to see availability. But behind the scenes, there's all these great analysis tools. Number one, like going out and looking at the algorithms of what all the competitors in the area are getting for a nightly rate. What are the hot nights? What are the cool nights? Right? What does MTR look like? Et cetera, et cetera. That's one, is the analysis tools. And then there's also the management tools that these management companies are using. They're using the analysis tools, but they're also using ways to help automate guest entry and exit with, like Wi-Fi locks. And they're also using it to organize and ping like cleaning crews and all that other kind of stuff. But they're also using it to create good invoices. So one of the things that I would also encourage investors to look for is who's the management team that you're working with, and are they leveraging some of these tools? Are you getting, nice, clear, concise invoices? Because there's a difference between just the guy that owns, maybe he owns 3 or 4 STRs himself. He's an investor and he's just like, doing it for his, a couple friends on the side, because he knows what he's doing and these are his buddies. I'm not saying there's anything wrong with that, but just like anything else, know who you're doing business with. I have a great appreciation for companies that really understand and leverage the technology correctly. As an investor, you're darn tootin', I want to have a solid invoice. I want paperwork. And again, this goes back to your conversation about leverage and full circle. So if I have paperwork and I've got invoices and then I've got deposits in my bank to show, right? And let's say it's all going into my LLC as an example, right?
Yep.
I can now go to the bank where I have that account and go, hey, look at what my LLC is doing. I want to establish a line of credit for my LLC. Now I've got access to even more capital to do even more deals. But I can't get that if I don't have good management. Because if just somebody's randomly handing me cash and not giving me good invoices and not good bookkeeping, things like that, right? I don't have the same ammo to show the bank, right? Or any bank or any other lender, So we're doing some of that stuff right now with some lenders here in Nashville. And because we have good documentation, it's working out very, very well. And again, to your point, starting off small and going. So, we're in that movement, which is exciting. We're moving into this hyper growth mode right now. And it's very, very exciting.
Hey, thanks for being a listener. To find great rental properties and become a more savvy investor, head on over to highreturnrealestate.com.
How do people get started? What do they do to be able to do this? Obviously, they can go out and do this on their own. I mean, I have a buddy I play cards with. He's got some properties that he paid $1 million for in Gatlinburg, which is a pretty high-end, type of destination play. That's not the game that we're playing. I think that's personally, I'm a more conservative investor and think that's pretty risky to buy those types of properties. I mean, these can draw down enormously, if we get into some type of recessionary environment.
Yeah.
What do they do to get started if they wanted to do this, but they don't necessarily have the experience and they don't want to take the time to go out and source properties? How can we help them?
We have a program called Systematic Wealth that's designed specifically for this. All you really got to do to get started is do the foundational module. And the foundational module has a number of different trainings, but essentially it's there to talk about those two specific items as they relate to real estate. Number one being debt, number two being taxes. So again, each investor is different. Everybody that comes to us, they have different income, they have different credit scores, they have different risk tolerances, things like that.
Different amounts of cash, investable dollars.
Different amounts of cash, and even with the different amount of incomes, they also may have different approaches to paying taxes depending on who their CPA is. Right. So this is I'm not talking about TurboTax now, or H&R Block. I'm talking about in this foundational program, you're going to get a bunch of trainings, but more importantly, you're going to get 3 calls. Number one is with Nicole, who's been working with us forever. She's amazing. She's our investor relations gal. And that's a go call. Get organized, go, G-O. And that's just to help you gather all your information and tee everything up. From there, you're going to have a debt analysis call with a debt analysis specialist. These are people within the network that we've associated with. And that helps you to understand your own debt positions. Do you have equity in your home? What are you doing with that equity? How are you paying off credit cards? How could you be more efficient in terms of the way your current debt structure is? So that's the next call. The third call, which I think is probably the best of all of them, is the tax analysis call. So within this module, we actually have a tool where we can feed your most recent tax return into a piece of software, again, technology. It's not going to give you a full tax analysis, but it will identify the major areas based on your return that are opportunities for you to save on taxes. In addition to that, you are also going to get a call with a tax analyst, a tax strategist. Now, this is not, again, it's not a CPA. Now, they may or may not be a CPA, but it's not a CPA call. It's a tax strategy call. It's there to set you up and say, hey, these might be some of the ways that you could look at leveraging this information that came out of the software to facilitate keeping the most amount of money in your pocket and by paying the least amount of taxes to the IRS, right? So there's nothing illegal about it. It's actually very legal, but it's leveraging and using the laws because they're so complex and so intricate that it's gotten to a point where you pretty much need software to do this now.
Sure.
So all of that trading, all 3 of the calls, all the tax analysis and everything is in that foundational module. And we charge $1,250 for it. It's probably worth $20,000 or more in value. It's super cheap. And we do it cheap because it's not like a big profit center for us. We're doing it because we want to get, to your point, investors into a position where they can do things correctly. Because honestly, to be selfish, if they're doing things more correctly, they're really better customers for us, right? It's a lot less aggravation all the way around. People understand what they're getting into, right? We end up being more profitable as we move forward into the later stuff where we're getting into selling of properties and things like that. So it's a win-win for everybody. And any investors obviously that want to go further beyond that, hey, you want to hire a tax expert, you want to build out full roadmap on how to do this strategically with different properties, all that, absolutely, you could do that, right? And of course, that costs more money to do that, but we're not asking anybody to do that. The beauty of this is the investor has access to this entire network, this ecosystem that they need all the way through. So like the lenders, the tax strategists, attorneys that can help set up LLCs, all that kind of stuff. So it's very exciting thus that we could basically have built this ecosystem for investors to help them be super successful.
Yeah, you don't have to do that program in order to get a property, right? Like you could just,
yeah, that's a good point.
You could just do a transaction. So I don't want to make anybody think like, oh yeah, you have to go through all those calls in that program. You could just buy a property, but you're saying that based on how you laid it out, that's to their advantage to, have that groundwork laid out in front of them before they go to purchase a property so that they can maximize all the debt and the taxation on that property. So
and that's a good point. I need to put an asterisk on what you said. When an investor reaches out to us, we're having a call with them, obviously with everybody that reaches out to us. And typically in that first call, we are making a distinction. And I hope I don't piss anybody off by saying this. I probably will, but we're making a distinction. So you're the kind of person that just wants to own properties, and that's okay. There's nothing wrong with it. Hey, I just want to get a rental property. I want to have a tenant, long-term, short-term, whatever. I just want to get in the game. Great. That is what we call somebody that wants to own rental properties. That is different than a real estate investor. A real estate investor versus someone that wants to own properties. A real estate investor says, yes, I want to understand debt better, leverage. I want to understand all the different products, the ways I can pay off properties, when it makes sense to refi, when it doesn't, when it makes sense to pay down a mortgage, when it makes sense to go simple interest only. How am I structuring my taxes? How am I strategizing? I mean, there's a big difference between going to your CPA at the end of the year and going like, okay, report on this. All they're doing is they can't change history, right? They're just saying, I'm going to report on what you did. I'll take whatever deductions we can, we'll put it down on paper, send it off to the IRS. There's a big difference between doing that. That's somebody that wants to own properties versus somebody that says, prior to this year ending and all during this calendar year, what am I doing to minimize taxes? That's a big difference. That's a real investor. So I want to make that distinction. And so when somebody reaches out to us, we're trying to determine where they land on either side of that argument. Now, it doesn't necessarily mean that they couldn't make a leap over here after they bought a couple properties. There's no question, and plenty of them do. But, this is more detailed. So if you don't have the stomach for it, it's okay. But just understand that there are certain things that you're not going to understand, and you'll likely pay more tax.
Good. Okay, so we're out of time, but to get a call going, they're going to meet with Nicole, our head of investor relations, if they're interested in getting started in the process.
Yep.
It's highreturnrealestate.com/cashflow, and that will allow you to book a call with Nicole, and then you can discuss which route you want to go. You just want a transactional, buy a property, or if you want to go through systematic wealth. Either way is great. We don't care that much. In addition to that, you just need to come to the table knowing what you want, essentially, or approximately what you want. So we don't have all this inventory that's already purchased and under our contract or in our portfolio that we're just going to say, here, pick from this. You're going to say, this is, I want to spend about this much on a property. This is kind of my range. This is what I have for cash to put down and to stage it. And then we will take that and our acquisition team will go out and find you what you're looking for, and we will get it under contract, assign it to you. Then, we have a management team that we have built out that is designed to help you to not have to do management of the property, which is, I'm sure none of you listening want to manage the property. I can't imagine any of you that really would, unless you're really trying to be an active investor and be, hands-on, involved, save the money on the management fee. But I would think that most of us have no interest in that. So anyways, that's how you get started. Just book that call with Nick, and she'll definitely guide you on the process. Guys, this is why you want to live below your means and be banking cash, so that you're in a position of strength when opportunities present themselves to accelerate your multiple streams of cash flow, like short-term rental play here, which we're so excited about it, guys. I mean, I'm just telling you the inner workings. Our team is meeting every morning for an hour or more to really dial this in and to really expand our own portfolio. This is the direction that we're headed, that Jack Gibson is headed with his own cash. Shecky's headed with his cash, right? This is where we're going. So we see a tremendous opportunity over the next few years to really accelerate your yields, put yourself in a position to create indestructible wealth. So thank you. Hey, Shecky, thanks so much for all your expertise. And I appreciate you joining the call and sharing. It's always a pleasure to have you
I always
on.
love having these conversations with you. It's great.
Yeah, it's fun. All right, guys. Well, thanks so much. Everybody have a great day. We will see you on the next episode.
Hey, thanks for your support. If this episode was valuable to you, then show us some love. Subscribe and take 1 minute of your time to leave us a review. This is how we get the word out to help more investors. And best of all, it's good for your karma.